How do I minimize my taxes on investments in retirement income?
Yes, to address that question, it's really comes down to the level of income that you're currently earning,
Mhm.
especially in the accumulation years. There's a certain threshold of income that determines whether you'd be more advantageous for you to contribute pre-tax and reduce your taxable income in the current year versus making a tax-free contribution and actually paying the taxes in the current year to experience the tax-free growth for the rest of your life. And as a general rule of thumb, if you are in the 24% marginal tax bracket or below, and you have over 10 years that you're going to be invested without taking distributions,
Mm-hmm.
it's likely advantageous for you to consider making Roth contributions, going ahead and paying the taxes now so that you can experience the tax-free growth for the remainder of your working and retirement years. So that is sort of a rule of thumb answer. But of course, if you have an opportunity in retirement where you're not going to be making much income, you can once again do the Roth conversion strategy and convert that pre-tax money into tax-free money at a much lower rate than you would have been able to in your employment years.
Yeah, and I mean, from a high level, I mean, to really get ahead of that conversation, I think, clients need to recognize that there is a disconnect between the party, the CPA or the EA that files your taxes, and your financial advisor. And finding a way to communicate and connect those two parties in our industry is really where clients need to sit and decide how they're going to be proactive about that. So starting that conversation early in the year so that you can get ahead of the tax bill in the following April. So we're talking about 12 to 13 months of time that you really have to be proactive about it to connect the dots and understand where you might land in April of the following year.